Man, when is this correction ever gonna end? I think a lot of newbies are having this feeling that this stock correction is going on forever, and day by day they are losing faith because it seems that prices just keep going down, and every time I buy the dip, it keeps going lower. I buy the dip, goes lower, I keep losing more and more money. It's very common for new investors to think that way, and forget that 90% of the time, if you look at history, the market is in a bull market 90% of the time. And 10% of the time, we are in a correction or bear market. But it's easy to forget because, it's not too long ago. It was just less than 6 months ago, we were in a bull market, right? And people have this recency effect that during the bull market, they forget about corrections. They forget about bear markets. They think it's always going to go up. Similarly, when you're in a correction and prices keep going down, you kind of forget that a bull market ever existed because you always think about what's happening recently and you think that it's never going to end, it's going to keep going down. Now, I can tell you that after studying the last 120 years of history of the US markets and being in the markets myself in the last 30 years, that every correction will end. It will always end. And after every correction, the market will then go back up to all-time highs. It will always happen. This is just the last 10 years. After correction, market goes to new all-time highs. Every time it corrects, it goes new all-time highs. Every time it corrects, goes to new all-time highs. Everything corrects, goes to new all-time highs. And now it's no different. The only thing is, how long is this correction going to take? How much closer are we to the bottom before we then go to new all-time highs? So let's take a look at history and make some intelligent guesses of how long this correction is going to last. So from 1950 to 2021, this is the last 72 years, there have been altogether 34 declines in that time. Now, a decline would be either a correction or a bear market. So a correction is when the market drops more than 10% to 20%. A bear market is when the market closes below 20% and goes way below 20%. So that's the difference. Now, again, in the last 72 years, there have been 34 declines. So roughly, you have got a decline every 2 years. Now, the last decline, which was a bear market, was in 2020. All right, 2021, no decline, more than 10%. And now 2022, we have a decline more than 10%. So it's right on cue if you think about it. It's kind of like due this year that we have that decline once in 2 years. Now, out of the 34 declines, 11 of them turned into a bear market. So a bear market, again, is defined as when the price of the S&P 500 closes below 20% and then goes lower than that. So in other words, people ask me, Adam, what's the chance of us going to a bear market? Well, based on history, statistics, is a 32% chance. Now, if we take a look at all the corrections in the last 72 years, there were altogether 23 corrections, which means market dropping more than 10%, but up to 20%. And if you look at all the corrections that are ones in black, 14% correction, 15%, 11%, 14%, 10%, and so on and so forth. So total of 23 corrections. How long did it take to reach the bottom? Well, again, like this took 35 days. This took 252 days. These are calendar days, by the way. This took 28 days. So if you take an average, it takes an average of 131 days for a correction to reach the bottom. So that's roughly 4.3 months. And how long does it take from the bottom of the correction to get back to a new high? Well, again, if you take the average, 70, 175, 35, take the average, you get about 129 days, which is about 4.2 months. So interestingly, for corrections, it takes roughly the same time to get back to the all-time highs than it took to reach the bottom. And for corrections, the average decline is 15%. So this current correction that we're going through, so far, the decline to the bottom has been 14% on the S&P 500, which means that we are now 1% away from the average. So that's a clue that we could be near the bottom, maybe, okay? And so far from the time the correction started, it's been 112 days. And again, the average to the bottom is 131 days. So looks like we have got 20 days to go to the average bottom. So if this happens to be a usual correction, then we could possibly bottom pretty soon. And looking at the price action, you can see that it looked like this was the bottom, right? We broke out of that resistance, which I mentioned, but it couldn't sustain, right? We came back down again. And now, based on the price action, it looks like we could be going back down to test this recent low. Or we could even go all the way down to 17%. And I drew this early this year because based on studies of previous midterm election cycles, the US midterm election, markets tended to correct up to 17% during those years. And this year is a US midterm election. So again, we could be retesting that level or that level before we bottom and before the market starts going back up again. The main catalyst for this stock market correction is the Fed having to raise interest rates aggressively and tighten financial conditions in order to control sky-high inflation, which is now 8.5%. So if inflation can peak and begin to come down, the Fed may not have to raise rates as aggressively as they project. So in other words, the key to the market bottoming would be if inflation begins to come back down. Is there a chance of that happening really soon? Well, according to legendary pattern trader Larry Williams, who's been in the markets longer than I've been born, yes. In fact, I highly recommend you watch his latest presentation on YouTube. I'll point it out later on. Now, Larry Williams has been forecasting inflation cycles, and they have been pretty accurate over the years. And this is from 1985 to the current year right now. And you can look at this inflation cycle. And if this is the cycle pattern, and you can see this is the actual inflation. So it kind of like peaks there, comes down, peaks there, comes down. I mean, it's not exact, but it's pretty spot on at times, right? Peaks comes down, right? Peaks comes down, peaks comes down, peaks comes down. And right now, this is where we are right now. And it is currently near the inflation cycle peak, which is roughly in the late second quarter of this year, which will probably be in late June, early July. We'll start to see inflation peak and come back down again. And again, once inflation comes down, that will be extremely bullish for the markets. In fact, again, if you take a look at Larry's research, and again, watch his video, I'll point it out in a while, but he has shown that inflation peaks have been the ideal time to buy stocks. Whenever inflation peaks and starts to turn down, that's a great time to buy stocks. Inflation peaks, comes down, great time to buy stocks. Inflation peaks, comes down, great time to buy stocks. And right now, again, inflation is at 8.5%. It is near its peak and will start to come down in the next month or so, which will be a great time for the markets to bottom. And very much in sync with what I've shown, that corrections tend to bottom in their fourth month and tend to bottom after about a 15% average drop in the markets. But we'll see how it goes. Again, recommend that you can watch Larry Williams' full video on YouTube. You can search for the title, Is It Time to Get Bearish? Now, some people are saying, but Adam, what if this is not just a correction? What if this turns into a bear market? It's the 32% chance you're talking about. Then could we go a lot lower? The answer is yes, we could. So if you take a look at the history of bear markets, again, bear markets happen 11 times in 72 years. So on average happens once every 5.6 years. And we just had one in 2020, bear that in mind. Now, the average bear market, you can see that most of them are accompanied by a recession, but not all of them. Some of them were bear markets that had no recession, and they were relatively smaller bear markets. But if you take a look at all the bear markets, you can see that the average time it took to hit the bottom of a bear market was 398 days, which is about 13 months, which is about 1 year of the market going down. Yeah, it could happen in a bear market. And for bear markets, it takes longer to recover back to the all-time highs. In fact, average bear market, it takes 746 days to get back to the top, which is about 24 months or 2 years. So for bear markets, it takes double the time to get back up than the time it took to drop down. And the average decline of a bear market is 35%. So if you've been watching the media, a lot of people are saying that a recession is coming, so it's going to be a bear market, and this is what we're going to experience. So, do I think so? I still don't think so. I mean, it could happen, but I doubt it. Why? Let me show you some numbers on the probability of a recession. Now, it depends on who you ask. First of all, understand that it's almost impossible to predict when a recession is going to come. In fact, if you look at all the previous recessions, no one could predict it accurately. And recessions tend to happen on things that most people never expect. Like, who could have expected the COVID pandemic, right? For example. So anyway, if you take a look at a recent survey of economists by the Wall Street Journal, most of them, on average, predict a probability of recession at 28% in the next 12 months. So that's your chance, 28%. Now, but what does the Federal Reserve themselves say? Well, you can go to their website, which is FRED, the Federal Reserve Economic Data website, and they actually have a website or a chart that shows you the probabilities of US recessions. And you can go back to the last 50 to 100 years to take a look at this probability chart. And what they found is this. This probability chart is based on 4 monthly coincident variables: non-farm payrolls, the index of industrial production, real personal income, and real manufacturing and trade sales. So that's how they calculate this stuff. Now, over the last 52 years and over the last 7 recessions, every time this probability passed 20%, there's been a recession. All right. So have we passed 20%? No. In fact, you can see in April 2021, the probability of a recession from the Fed itself was 0.7%. In August or September 2021, it went up to 0.8%. And right now in February 2022, by the way, right now it's April, but they take time to do this research. So it's like about 1 or 2 months late. But as of now, the probability is near zero. So nowhere near the 20%. So based on the Fed research, doesn't look like there's going to be a recession. And if you take a look at the economy, the US economy is still really strong. Wages are rising. Unemployment is still going down. At the same time, household balance sheets are still very strong with a lot of savings. In fact, higher than pre-pandemic levels. So I don't see the same kind of systemic risk that we had back in 2008 during the financial crisis, or back in the year 2000, the dot-com crash, where a lot of tech stocks were losing money. I don't see that scenario right now. I see the US economy is still really strong. I see the US markets not that crazily expensive. In fact, quite a number of companies I mentioned are undervalued. So even if we do get a bear market, I don't see like a big bear market. It could be like a short bear market, not a recessionary kind of 2008, 2000 kind of bear market. Now, of course, things can get worse under 3 conditions. The first is if oil prices go up like crazy and that triggers a global depression, but that's not happening. In fact, now oil prices are coming back down, so that's not a worry anymore. But there are 2 more worries. The second worry is, of course, if Putin goes nuclear. I mean, if that guy goes nuclear, that could really set off a global problem. And of course, the third issue right now is the US housing market. The US housing market has gone crazy. It's up more than 50-60% in the last 1 year. And it could be now in a second bubble 2.0. And with long-term interest rates rising, mortgage rates now above 5%, it could go to 6%. That could cause the housing bubble to burst. And that could trigger a recession. But the good news is that a lot of homeowners, unlike in 2008, they are not the subprime owners. So lending has been a lot stricter. So people have a greater ability to service the loans. So there's less likelihood for default in the housing market. But these are the 2 main concerns that I see that could, of course, jeopardize this entire market. Now, at the end of the day, the question is, what do we do? What do we do as investors? What do we do as traders? Remember, no one can predict when the recession is going to come, or if it's going to come at all. No one can predict exactly where the market is going to go. So what do we do as investors? What's the smart thing to do? And the thing to do is this. Whether you're an investor or trader, you have to stick to your plan. Stick to your investment plan. Stay the course and not halfway change plan or abandon your plan just because the markets are going down and you're freaking out. Mike Tyson famously once said, everyone has a plan until they get punched in the mouth. And a lot of people now are getting punched in the mouth because of the markets going down and they forget their plan. So you got to stick to your investment plan. So for example, if your investment plan is to buy great companies when they're undervalued, stick to it. Keep buying great companies. And there's no reason for selling if there's nothing wrong with the underlying business. Now, if your trader is different, in trading, when you enter a trade, there's always a stop loss. Once it hits a stop loss, just get out and enter a new trade when you see a clear trading setup, right? Now, for me, majority of the time, I'm an investor. So what am I doing? I'm sticking to my investment plan. I'm holding great companies that I know will go higher eventually. They may go down in the short term. I ain't selling shit, all right? I'm holding my companies. In fact, I consistently keep buying when they hit new support levels. But disclaimer, as you guys know, I am using options to hedge my investments. I'm using options to short the market, so I make some short-term profits as the market goes down temporarily. Now, the trouble is a lot of newbies, they have this thinking that, hey, you know what? What if it gets worse? What if the correction keeps going down? What if there's a bear market? I'm going to sell before things get worse. And in my opinion, that's the worst thing you can ever do, right? You never want to sell, especially if you're holding good businesses. And I've said this many, many times during all the past crashes. Back in 2020, I said, don't sell. Back in 2018, I said, don't sell, and sure enough, eventually when the markets came back, people said, Adam, thank God I didn't sell near the bottom, or thank God I didn't get out. Because most of the time when you sell, you never get back in at a good price anymore. You may never get back in, or you get back in at a very high price and you miss out on the market. So don't do anything that you regret 1 or 2 years from now. And if you take a look at research, it's never been a good idea to sell stocks of good companies during corrections. If you take a look at this research by Morningstar, you can see that if you simply stay invested in the stock market through the ups and downs of corrections, this would be the outcome of your money growing, right? But if you think I'm going to get out of the market, exit, and get back in 1 year later, most of the time, this is what happens. You will get a lot less than just staying in the markets. The worst thing that you can do is to exit the market and never get back in again and just hold the cash in fear, right? Because if you did that during the financial crisis, this is what would have happened to your money years after the financial crisis. So you can see that, hey, this was one of the worst crises in US history, but staying in the markets was always the best outcome. Now then some people say, hey Adam, could I kind of like sell now and buy back later at a better price? Now, who doesn't want to do that? That sounds like a great idea, but more often than not, you often, again, get back in at a worse price, or you never get a chance to get back in at all. One way is to look at trends, right? So you get out on a downtrend, you get back in on an uptrend. And a lot of people, they use moving average crossovers. One of the most common ones is known as the death cross, where the 50 moving average crosses below the 200-day moving average. Now, I look at the 50 crossing below the 150, and some people look at the 50 crossing back above the 200. Now, at times, it does work really well. For example, during the dot-com crash and the financial crisis, if you got out during the moving average crossover and got back in at the reversal of the trend, you would have avoided that big drop and you would have gotten out here and gotten back in there. Yeah, it can work at times. But what I've noticed is that out of the last 11 bear markets, if you did this, get out and get back in again, out of the 11 bear markets, you would have been better off in 2 of them. 2 out of 11. And 9 out of 11 times, if you got out and got back in again, you would have been worse off. You would have got in at a much higher price. It's just the way it is. So for example, if you got out during this crossover here, during the COVID crash, and you bought back in again here, you would have missed out a lot. So in the past, I used to jump out of the markets on downtrends and jump back in on uptrends. I used to do that years ago. But what I found is that if I didn't do that, if I just stayed in the markets through the ups and downs, I would have actually made more money eventually. So it's something that I've learned over 30 years of being in the markets. So is there any situation where an investor should sell stocks right now? Yes, there is. You should sell stocks if, number one, you're holding low quality stocks of companies that are losing money, or stocks that are overvalued. Then yes, that would make sense selling the stocks, but then taking the cash and reinvesting that cash into high quality companies that are undervalued. So that's one situation to sell. Or number two, if you are over leveraged. So if you're someone who has borrowed a lot of money on margin to buy stocks, then yep, I would get out, all right? Because if you don't get out and it gets low into a bear market, you could get completely wiped out. And that's why I keep telling my students, don't invest with borrowed money. Only invest with money that you don't need to use for at least the next 3 to 5 years. Then you have no worries, right? Market goes down in the short term, who cares? Because you don't need the money, it'll go up eventually. But if you need the money and you're forced to sell, that's the worst thing that can happen, because you're forced to get off the markets because of margin calls, and you're not there anymore when the market rallies back up. Now, if you do want to get off the markets because of these reasons, then never sell the low, all right? Now, remember, on a downtrend, the market will not drop in a straight line. It will not drop like that. It would go like that. It would drop, it will rally up, drop, rally, drop, rally, drop, rally. So if you want to get out for whatever reason like this, wait for a rally to get out. Wait for a rally and sell. Rally, sell. The problem with most people is they tend to sell at the bottom of a downtrend. So when it drops, they panic and they sell. And what happens the moment they sell? That's right, the moment they sell, it goes back up again, and they go, shit, and then they buy it again, and it drops again, and they sell again, right? They keep losing more and more money that way. So for me, what's my strategy? My strategy is I'm holding great companies, I ain't selling shit. In fact, I'm just buying, right? I just keep buying, just keep buying, just keep buying. But again, I'm buying only good companies, high quality stocks, which I've talked about very, very often. These are companies that will always go higher eventually, and a correction is a great time to accumulate shares of these stocks. But again, it's always buying within my planned allocation. I teach my students that in a portfolio, each stock should not have more than 5% allocation. Now, that's me being conservative. So the moment it hits 5% allocation, that's it, I don't buy anymore. And the key to buying is that you never buy all at once. For example, I really want to buy Apple. I sold Apple in the past, I made a lot of money, and I'm waiting to get back in, but I'm not buying yet because it's not cheap enough yet. So eventually, I would like to buy up to 5% of Apple in my portfolio. Am I going to buy 5% at one go? No, I'm going to buy 1% first, and then another 1%. So I always average in my position. So one way to average in is to buy the moment the price hits support levels that you can identify. And I tend to use moving averages. So if you look at Apple, for example, this is Apple. And if you look at the long-term chart, you can see the very strong support level at the blue line, the 50 moving average. Can you see that? Very strong support, right? So that's definitely a buy level for Apple. $93 is a buy level for Apple, okay? And it also finds support at the 40 EMA at times. So that's another buy level, 115. And you can see it also finds support at the 20 EMA on monthly candles. That's the red dotted line here at 142. So you can see that for Apple, I've got 3 buy levels, 142, 115, and 93. So for every stock, I have at least 3 to 4 buy levels. Why? Because when Apple hits the buy level, when it hits 142, I will start to buy some shares. Hits 115, I buy more shares. Hits 93, I buy more shares. So I always average in my position, dollar cost average. So by doing that, I always ensure I never get in near the highs. All right, I always get in near the lows as much as possible. Now, for those of you who are not sure how to use moving averages, I can share with you a very simple technique. And the very simple technique is this. For example, if you're buying into the SPY, the S&P 500, here's a simple rule of thumb. Buy your first tranche when the price drops 8% from the high. So currently it has already dropped about 10 to 14%, right? So you could have bought the first tranche. Now, if it continues going down to 15% below the high, then you buy the second tranche. If it drops 21% below the high, you buy the third tranche. And if it drops to 35%, you buy your final tranche of stocks. Right? Let me say why these numbers. Okay, now there's a reason why these numbers. Okay, why 15%? Right? Because I showed you that the average correction drop is 15%. So that's why. And roughly what's half of 15%? It's about 7.5%, right? So I round it off to 8%, where you can begin your first buy level, right? Now, why 21%? Because if you take at the average of all the bear markets and all the corrections, the average drop is 21% across all declines. If you take the average drop across all bear markets, is 35%. So you always want to have that last ammo to buy during a bear market, right? And if it doesn't hit that bear market, fine, you just go in 3/4 of your planned allocation to a stock or investment. So by doing that, you always ensure that you always have enough ammo to keep adding as the market keeps going down. So while I'm buying stocks as investments for the long run, but at the same time when I see the market coming down in the short term, I'm shorting the market using put options. To be specific, put option spreads. So for example, last week when I saw that the S&P 500, it was not able to break its resistance and it began to close below the 50 moving average, I said, hey, chances are it's going to go down again in the short term to probably test this support level over there. So I have been shorting the markets, and again, I've been sharing this in my options trading group. So I've been shorting the triple Qs as well, as early as you can see the 11th of April. I said QQQ, which is the NASDAQ ETF, looks like it's maybe going down to retest the March lows. I entered a bear put spread on triple Qs, buying the 342 put and selling the 320 put for a risk-reward ratio of 1:2. And I explained the trade here as well in greater detail right here. Yep. So I explained that, hey, you know what? It hit the 50 moving average. Is now coming back down. So QQQ can't seem to break the resistance. So I entered more QQQ bear spreads. I've also been shorting Alibaba actually as a downtrend. I've been shorting it, getting some profits, but still holding Alibaba in my long-term investment and still making money in the short term as well. So that's always a way to have an investment and trade around that investment. So you also benefit during the short term downtrends. I also added some SPY bear put spreads, as you can see, on Friday, as I expected the SPY to go down as well. So again, bottom line, in the short term, I do see the SPX going lower to retest the lows here, and it may even go down to 17%, which I highlighted early this year because US midterm election has had a 17% decline on average. But in the long run, the markets will go up. In the long run, good companies will always go up. So I'm buying good companies as well when they hit support levels. So the bottom line is that, remember, corrections don't last forever. Even bear markets don't last forever. Corrections will end. And once they end, the market will then take off again to new all-time highs. So never be afraid of corrections. If you're holding great companies, continue holding them. And I continue to add more and more shares to these great companies at lower prices, because once the market bottoms and the market makes new all-time highs, that's when you'll be richly rewarded. Remember, the market transfers well from the impatient person to the patient person, from the emotional person to the rational and logical person, from the pessimist to the optimist. So you can choose to be patient, to be optimistic, and to be rational. And you will build your wealth over time. I guarantee that. So may the markets be with you always, and hang in there for the ride, because it will only get a lot better. If you want to catch my latest videos, click on the subscribe button right now Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.